Welcome back to the Conch Economist. August was a good month. We had a revision of the gross domestic product for the second quarter revised upward to 3.3%. Inflation was still running closer to 3% than 2%, unfortunately. Unemployment was holding steady at about 4.2%. Stocks were at all-time highs. So all in all, not a bad August. And we're looking forward now to the Federal Reserve meeting in September coming up in 2 weeks. At such a meeting, they are anticipated, widely expected, to lower interest rates. And for some people, that's long overdue, particularly if you are shopping for a house or you are any way at all connected with real estate. It's going to be interesting today to really examine what is the cause of inflation. In fact, this is going to be the first part of kind of a two-part presentation that I'm going to make on this issue of inflation. What has caused inflation and what might we be able to do to cope with it? It's clear, I think by now, and it certainly is becoming clear to the Federal Reserve, they're not going to be solving the inflation problem anytime soon. We are a long way from a 2% inflation rate. We are now at about 2.8, 2.9, and I don't anticipate much of a drop between now and the meeting that they have in 2 weeks, or even 2 weeks after that. As we're going to see here pretty soon, the cause of our inflation was not low interest rates, hence high interest rates are not going to be able to solve it. And we're going to also, in a later episode, a later program right after this one, I'm going to be dealing with some things on how we might be able to cope with this. But today we want to concentrate on really what has been the experience in our economy over the last 8 years, really, and what we can look at, what do the data show us, what were the real causes of inflation, and in a subsequent program, how we might be able to cope with this. I want to take just a brief period of time here to review what has been our experience over the last 8 years in terms of two major parts of our economy, of our society, our population, and our gross domestic product. First of all, looking in 2016, our population was estimated at 325,742,000, and that's as of December of that year. I'll point out that this is an estimate. Our best figure here is for 2020, where the population is shown to be 332,113,000. This was based, of course, on the census. Figures either before or after and any other intervening years would be as a result of analysis of birth rates, death rates, immigration, and so forth. By 2024, the population was estimated to be up to 341,320,000. Percentage-wise, during the first 4 years there, just a little under 2%. But quite a bit of jump here in the next 4 years to 2.77%. From a actual headcount point of view, the 4 years that we have from 2016 to 2010, the gain there was about 6.37 million. After that point, for the next 4 years, the gross increase here in terms of actual people, about 9.2 million. I suspect that part of that is due to an increase in immigration, some of which we would know about and some of which we don't, because not everybody was documented that came in. So over the entire 8-year period here, we're showing an increase in population of about 4.78%, just say roughly under 5%. Remember this if you can, because it'll be important when we get into some of the data later. Now, over here, we're looking at real gross domestic product. Now, when an economist uses the term gross domestic product, real gross domestic product, we are adjusting for the effects of inflation. In other words, we're trying to count the actual number of loaves of bread that were baked, or the actual number of cars that were made, and so forth. And so we are expressing this in trillions of dollars, which is a big number. By the way, speaking of a big number, a trillion is a 1 followed by 12 zeros. 1 followed by 12 zeros is 1 trillion. So when we say that the real gross domestic product was $19.3 trillion, it's a big economy. And gross domestic product refers to the dollar value of goods and services newly produced in the economy during that period of time. If you bought a secondhand car, that car does not count as this year's gross domestic product. It would have counted in the year that it was made. If you buy a house this year and the house is 4 or 5 years old, the value of that house would not be reflected in this year's gross domestic product. It would be have been reflected in the year that it was built. However, if you buy, say, a house this year, any costs connected with that transaction would be part of this year's gross domestic product. Well, as we can see, during the 4-year period from 2016 to 2020, the increase was 7.6%. In the next 4 years, we had a jump in gross domestic product by over 13%, so almost double the gross domestic product gain in the second 4 years here versus the first 4 years. Over the entire period of time, the increase in gross domestic product was just under 22%. So keep this in mind, that over an 8-year period, we had an increase in population of just under 5%, and we had an increase in the actual economy in terms of producing goods and services of just under 22%. And I need to adjust this so we can see this. 4.7% here and 21.9% here. Sorry for that. We're going to see exactly what was the real cause of the inflation that still afflicts the economy. We'll start again here with the year 2016. And I've got three major items here. I've got our national debt, I've got the money supply, and I've got the consumer price index. In 2016, the beginning of our reference period here, our national debt was a little over $19 trillion. These figures are for the fiscal year ending 9/30. The U.S. government fiscal year ends on September 30th, and so our data here for the national debt are in terms of a figure as of September 30th. And we can see that now a national debt, this is the amount of bonds and bills and so forth, notes that the Treasury has as outstanding obligations. The real culprit is our increase in the money supply. And there's more than one way to measure the money supply. We're going to be using M1, which is the more conservative approach. Again, these are in trillions of dollars. And in 2016, our total money supply was a little over 3.3 trillion, of which most of it was in the form of what we call demand deposit liabilities. The currency component was 1.4 trillion, which was basically 42%. This column here shows the percent of the total money supply that is accounted for by currency. Down through the years, the bulk of the money supply has been in what we would call demand deposit liabilities. Essentially, this is checkbook money. Anything that can increase the balance in your checkbook increases the money supply. And of course, we can, as they say, run the printing presses, and that would be currency. And we do increase currency over a period of time, but by far and away, if the Federal Reserve is going to increase the money supply, they will do so by taking actions that result in an increase in what is called demand deposit liabilities by the bank, and which you refer to as your checkbook balance. I'm using another reference point here of 2019 because this is kind of the last reference point before things really start to happen. In 2019, our M1 money supply was just over $4 trillion, and our currency was, again, the minority portion there, and it always is. Now it was up to about 1.7 trillion. But what's interesting here is that over a very short period of time, basically 12 months, from December of 2019 to December of 2020, our money supply went from 4 trillion to over $17 trillion. from 4 trillion to over 17 trillion dollars. This was an increase of this 12-month period of over 345%. Folks, I went back to 1960. I went back decades, and never did I find any time that the money supply increased by such a tremendous amount in a very short period of time. Think about it. The money supply during that period of time, 12 months, went from 4 trillion to 17 trillion. This is the culprit of inflation. This is where our inflation has its beginnings. And it didn't end there. 12 months later, we were now up to over $20 trillion in money supply. Now, it is interesting to note that over a period of time here, currency, which is paper money and so forth, did increase, but of course it was a minority of the total money supply when compared with the outstanding checkbook balances. Again, a couple of reference points here. M1 as a percentage of the total was 42% here in 2016. It dropped to 11.1% in 2020. Still remained about the same 4 years later in 2024, when the money supply reduced just ever so slightly to 18.3 trillion. Currency increased a little bit to 2.27 trillion. So it was, currency now went from 11.1 to about 12.4. Again, a minority. The bottom line to look at here is that, one, the money supply increased significantly. Secondly, most of this increase is as a result of an increase in what we call demand deposit liabilities. That's how it's carried on the books of the bank, which you call your checkbook balance. Now, remember earlier, we looked at what was happening to the population over an 8-year period, and we saw that it was just under 5%. Look what's happened over the 8-year period to the money supply, 442% increase. And remember, real gross domestic product, when we hold prices constant, when we look at just, the actual increase in production of goods and services, just under 22% over that same period of time that the real economy was growing by about 22%, the money supply was increasing by over 442%. There's no mystery here as to what is the problem. A tremendous, unprecedented increase in the money supply. And not surprisingly, the national debt increased also by a very significant amount. Again, remember, the population went up by just under 5%, but our national debt over that period of time went up nearly 80%. Our real GNP increased by just under 22%, but look at the national debt, over 79%. What was causing this? Please understand that when the Treasury sells bonds to the Federal Reserve, this sets in motion a series of transactions and operations that result in an increase in the demand deposit liabilities, or if you please, the total money supply. So as the Treasury is selling more bonds, we see, of course, the national debt going up. And as the national debt is going up, our total money supply is going up, because as a result of selling these bonds, we are increasing the money supply. So over this period of time, over this 8-year period, we had a tremendous increase in the money supply, a tremendous increase in the national debt. And then let's see what happens here to prices. Don't be surprised that they don't take a big jump also, and they do. Over this period of time, the consumer price index, with 8284 being a base, increased by 30%, over 30%. You are still experiencing those gains today. Prices have not gone down, and in fact, since the end of 2024, we have continued to see an increase in the consumer price index. And the Fed is trying to get it down to 2%. It's now still running closer to 3%. So we can see, what is the culprit here? The culprit for the inflation that we have is the tremendous increase in the money supply. Milton Friedman, famous economist, famous monetary economist, always observed that inflation is always and everywhere a monetary phenomenon, and this clearly illustrates the point. Well, I think we have clearly identified the cause of our inflation. It's because of a tremendous increase, an unprecedented increase in the money supply. So clearly, maintaining interest rates at their current levels, which the Fed has been doing now for most of the year, since last December, has not cured the inflation problem. How could it? How could maintaining interest rates cope with this tremendous increase in the money supply? I'm going to deal with some ways that we might be able to cope with this, but it's clear that the Fed is probably giving up on the idea that their interest rates are going to solve the problem of inflation. It hasn't and probably can't. We're going to have some fiscal discipline. The national debt has got to be controlled. The national debt has got to be reduced. We're paying estimated almost $1 trillion a year on interest. And not all of that interest is going to Americans. People all over the world own bonds, and they're receiving interest payments on these bonds. It's not my nature to be doom and gloom, but I thought I should present this information so that we can all have a better view as to what the real problem is here in our inflation and why there is not going to be a quick fix, but there are going to be some ways that we can cope with this. And so in the next program, I'll try to raise some of these issues and address some of the possibilities. So that's all for now from the Conch Economist.